you've so many nodes that have opened up and all that, but we also need to target looking over and above and beyond. But there are quite a number of other factors that you need to answer. Really, even from the outset, you have to think of that asset management function that will come into play as you go down. You have to think of the property itself, the quality of that property, for example, because property management, facilities management on an ongoing basis for assets in the REIT it's very critical. And for us as Fahari, I think we have a lot of lessons on those two components, property management, facilities management, as functions are under the asset management function. We've learned a lot. So when we say look at properties, do a thorough DD at the outset. That DD has to be, I mean, it has to be detailed. It's not just cursory. It's not just top level. A lot of us do top level DD until you own those properties, and then you realize, wait a minute. It's requiring a lot of capex just to fix things you might even have uncovered. So there are a lot of lessons that you could pick, but I think at the outset, that component of DD, if you're buying properties, especially in our market in Kenya, and if you're not buying from and good, there are developers that at least you can trust. But the others, it's a good property, but we need to actually ask the questions. So I think as we go along, I will be discussing a bit more. I have a whole list, but I think let me add over back to Ken.
Thank you, Raphael. So I think the next point to consider is you've done your portfolio, you've got your properties in, and I'm coming to you, Azmeena, here. So what are the key considerations that you take into account for property management, rent collection, building maintenance, and sort of overall asset management now that you've got the properties in a portfolio?
Okay, so thank you, Ken. I'm going to qualify my response by saying I'm not a REIT manager, but I've cut my teeth on like the entire property life cycle, right? So I started out with, doing program management of very large public sector projects, and then when I came to PDM, getting involved in the facilities management side of it too. One of the things that I can tell you clearly, and I think everybody agrees, data is king. So any aspect of the property development phase or the facilities management phase, it's absolutely critical that you have systems and processes in place to collect data. It's an investment, both in time and software and all of that, but it is well worth it in the long run. At PDM, we've implemented, we use SAP for our accounting system for property management and rent collection and stuff. But we've had to add on enhancements and other pieces of software that we can integrate with it in order to do proper computerized maintenance management. Right? And that includes like tracking every single piece of equipment in every building in our portfolio, understanding the maintenance history on all of these pieces of equipment, implementing preventive maintenance plans, tracking costs, tracking whole life costs, replacement considerations, all of that. And with every piece of equipment, right, it's tied to a location, it has access to the user manuals and all of that, so that we can also remotely manage and have access for our technicians on mobile apps, so that when they're out there doing maintenance, they have instant access to the data that they need and the instructions that they need to be able to maintain those particular systems and equipment. In addition to that, we're now looking at integrating with building information management systems, creating digital twins. So we're trying to take advantage of technology in every which way to be able to, optimize the performance of our assets. Smart technology is another piece that plays a big part. And so we've also started implementing wireless sensors in all of our buildings to control lighting and thermal comfort, for instance. And we're just starting on that journey, but I can give you an example of a building in London where just by implementing smart technology, primarily related to thermal comfort, they were able to reduce their energy costs by 50%. That's 50, not 15. So there's a lot that can be done, to optimize performance of assets. And that, going back to Raphael's point of the value of the asset, right? Reducing your operational costs, getting your return on investment accelerated, and being able to then also have a sustainable and attractive asset that you can dispose of when you're ready to do so is very, very important. So that's my 2 cents worth, Ken. Thank you.
Thank you, Azmeena. So we've got the strategy, we've got how you manage it. One of the things that you'll hear as a recurring theme is how to attract capital into REITs, and that is critical because REITs work best on scale. So here I'm coming to Raghav, somebody who's had a lot of experience in this. So if you want to grow your portfolio, you definitely need to fundraise. So what are the key considerations you take into account while developing a long-term, ongoing fundraising campaign?
Thanks, Ken. So first of all, unlike my good friend Azmeena, I was a REIT manager, but I probably made stuff up as I went along. So take everything I say with a pinch of salt. As far as I think the fundraising strategy is concerned, I think the first port of call is to start off by identifying what is the set of investors that you're going to be targeting. Because the fact is that REITs are a very different animal to other real estate type investment opportunities. When I was in space, I used to say that REITs are very much a lazy man's investment or a lazy person's investment, without wanting to be sexist. And what that means is that you're meant to invest your funds in a REIT and then just sit back and just enjoy a consistent flow of dividends, a more predictable flow of dividends. A couple of weeks ago, I was in London for work, and I met someone, and we were just talking about REITs, and he was telling me how he's been invested in a REIT for I think almost 10 years, and like clockwork, they pay you 2 pence a unit every quarter, and that's all they do, right? So you just know that, like, without hesitation, that's what's going to come into your bank account. And I think that's the aspiration that a REIT should have. But then on the flip side, that's an indication of the type of investor you want. Someone who's not going to be banging on your door and saying, oh, where's my return? You've spoken to them at the outset about what is what Raphael mentioned, what he emphasized. You've let them know the expectation on yield, and that's what you just consistently deliver on, quarter on quarter. Someone didn't like what I was saying. Thank you. So I think when I was fundraising, one of the things that we were also clear on was that we weren't going to be looking for the types of investors that sometimes you describe as hot money, right? Someone who's kind of coming in and expecting that in a year, 18 months time, I'm going to have a 20% return, because that's very puntish, right? There are those types of investment opportunities, and I'm sure they work out for people. Sometimes they don't work out as well. But you're coming in at the outset knowing that you're taking a bit of a gamble. A REIT shouldn't be a gamble. It should just be something that is there for patient capital. You come in and you're sticking around for at least 5 years or 10 years, hopefully longer, because really all you're expecting is that consistent coupon flow. And I think that's extremely critical. From a fundraising perspective, once you identify what is the set of investors that you should be speaking to, then you know that that's the only set of investors you should be speaking to. You're not spreading your net out too far and then kind of spreading yourself too thin and having too many knockbacks. You know who you have to go to. And the other thing I would say, what Ken premised in his question, is that REITs are all about scale, right? So the fact is that you want to be able to scale up your portfolio over time. Okay, so if you want to scale up your portfolio over time, then you need to have the confidence that you're going to be able to go back to the same investors and seek them to top up their investment over time, right? And along the way, of course, as you show a track record, you deliver results. What you'll also be doing is, getting new investors on board, which is always a good thing. But what you don't want is someone saying to you, okay, here's let's say, I don't know, 5 million shillings, which was the minimum, and then they go quiet for a long time, because what you want to do is develop that confidence over time. So I'd rather take a smaller portion of that 5 million so that someone kind of holds back and invests more, so that they're also able to keep their stake building up, or at least maintained at a certain level. Whereas if someone invests just one time, and then subsequently when you go for further fundraising, they're not participating, then they're going to get diluted. And at that point, their investment is not going to be as lucrative for them as it would be for someone who consistently tops up over time. So I think, that's just to give you a flavor of how to align your fundraising strategy, both in identifying the set of investors that you want to speak to, and also what you speak to them about in terms of how they should be allocating capital for the investment opportunity that you're presenting.
Thank you, Raghav. And just sticking with you, in this part of the world, we've got income and development REITs. Obviously, each REIT must have a manager. Perhaps what we'd like to hear is, as you are making it up going along, what are some of the interesting quirks that you found in managing the two types of REIT as a manager?
So, because as context for those that might not be familiar, there were two REITs that we had set up. One a development REIT, the other an income REIT, and that was also part of an earlier question, which was the portfolio growth strategy, right? Because the D-REIT was essentially the pipeline feeder for the income REIT, because in the space that I was managing previously, you couldn't go out to market and find purpose-built student accommodation. So essentially you had to do it for yourself. So that's one way that one can think about portfolio growth as well, is that you essentially do it for yourself by having a D-REIT and an I-REIT sitting side by side. But in terms of kind of the nuances of managing the two vehicles, the income REIT, I like to was the simpler beast, right? Because you're acquiring ready-made buildings. They should be stabilized, they should be operational, they should be occupied, so that they're able to generate the coupon that is the expectation from them. And so really for someone who is looking to set up an income REIT, the key focus, the key area of concern is, can you identify enough assets that fit that criteria, that fit that bill, that will consistently generate net operating income that enables you to pay out a dividend consistently. The development REIT is very interesting from the perspective that it's a cash guzzler, right? The development REIT, because you are developing projects within a REIT, it's for many of us who've just developed projects just by themselves rather than through a REIT. But with a REIT, you're developing a portfolio of projects. So then you have to start thinking about, you really have to kind of plan cash flow, not just for one project, but across a portfolio of sometimes 4 or 5 projects, and how you allocate capital across all 4 or 5 to ensure that they are consistently streaming along, that there's no holdup. And that can be quite a challenge, right? Eventually, you get to a stage when once a project is complete and it's ready to be transferred or sold, that you'll be able to generate proceeds that you can then funnel back into the other projects, or then you pay them out to investors. But it's a very different mindset, and it involves a lot of kind of almost, like I would say, day-to-day management. I mean, that might sound excessive, but it involves day-to-day management of ensuring that you're always liquid. Whereas with an I-REIT, you don't have that as much of a concern because you will fundraise for an I-REIT when you have an asset that is ready to acquire, but otherwise you don't need to raise any funds because it's just generating funds for itself.
Thank you, Raghav. So one other conversation that I think revolves around property, green, ESG, sustainability, and the like. And I'm coming to you, Azmeena, with the experience of the Kenya Green Building Society. What are your key thoughts around developing sustainable long-term use wrapped up in sort of an asset manager thought process?
Okay, so I'm going to start with just the development side of it and then talk about asset management. But Sam from Mwito Homes already sort of touched on the importance of sustainability. I think at the last REITs conference I had mentioned this, that 80% of the buildings in sub-Saharan Africa are yet to be built, right? So we have the opportunity to do it right. And we need to demystify what sustainability and green development means, right? There's a lot of, I think, misperceptions around the cost, the complexity of developing green buildings, and it's not that way, right? So Kenya Green Building Society is obviously, that's one of our mandates, is to make sure that people are aware of how you go about doing this, right? And in general, those costs, premiums that were perceived in the past, they were there. They still are to a small extent, but they've been coming down steadily. And when you look at the cost benefit, it's really worthwhile. So I can give you a personal example, right? And again, I've spoken about this before, but PDM developed Vienna Court, which is a grade A office building in Upper Hill in Kilimani. And we decided to LEED certify it, right? We paid about 3% premium to go green, and it's LEED Gold certified, right? We had leased one of the wings, which is almost 50% of the space, before we even finished construction, primarily because it was a green building, right? We've been collecting rent in US dollars for the last 6-7 years, and will continue to do so. And those rents are at a considerable premium over what the market in that area is, right? We are saving a substantial amount in operational costs because we have solar PV that, that powers our entire 4 basements of parking and all of our common areas. So there are a lot of benefits that result in huge operational costs, savings that literally, again, as I said earlier, really improve the ROI and the payback period on your building. Most of these, green building improvement measures have a very short payback period. It's usually about 3 to 5 years. So it's really, really important that we consider this, because if we don't, we're going to end up with stranded assets. Regulations are evolving and are going to get stricter and stricter. We have our NDCs, our nationally determined contributions that we're going to have to meet. And the built environment is going to contribute a huge amount to achieving those NDCs, because obviously we're one of the biggest contributors to greenhouse gas emissions and stuff. So I think, as Sam said, and I agree 1,000%, we need to embed sustainability into the requirements for the REITs and properties that go into the REITs. The added benefits obviously are resilience, extended life, extended value of the property, again, for resale and stuff. My recommendations on the asset management side, again, starts with development. You need to involve your facilities management team up front. Right, your energy managers, which is another component that's mandated by EPRA now for designated facilities. Those are the people that are going to make, and your sustainability consultants, obviously. Those are the people that are going to make a huge difference, right? If you involve them from the beginning, that's where you can minimize your cost premiums and optimize your ability to significantly improve the performance of your final building and hence your operational cost savings. I've got personal experience with projects that have come in late saying that they want to go green. And some of the measures that they've taken as far as selecting the materials and stuff literally result in it being impossible to change after the fact without a huge cost premium. So again, involve your teams early on, make sure you have their input in how you're developing your building. And it's not just related to sustainability, it's also related to property management and maintenance of the building. Thank you.
Thank you, Azmeena. So we'll be coming to you, the audience, next after this following question. So start preparing your questions. I think this one was Raghav's questions. You know, he loves problems and solving them. So with this, I'm coming to Raphael. I will read it as the way Zorava put it. What are the key considerations for governance around shareholders and marketing reporting? And also, how do you manage fluctuation in REIT unit prices versus asset pricing?
So, asset pricing vis-a-vis unit pricing, and then governance matters. Anyone familiar with governance knows that actually companies don't fail for lack of a good strategy. Almost all companies that have failed globally have failed from a governance perspective. And the beauty with REITs especially is governance starts with, of course, the regulator. The regulator has laid down key deliverables that we need to report on continuously. And of course, REITs would need at another level on to publish their results that goes out. Now, that doesn't mean that because we're regulated, you can't fail, because we've seen companies failing still that are regulated. So it comes down then to the governance structure, what's the composition of the board, as well as for the REITs, especially the trustee as well. So that's the beauty of REITs. We might at most feel that it's quite top-heavy if you're thinking about governance. You have the regulator, you have the trustee, and you have the REIT managers board. But I think the way it's designed is to ensure that actually REITs are going concerns. And if you look globally, really, we've not had a lot of issues with REITs or REITs failing or anything. They probably struggled from an investment strategy perspective, which been resolved, but not from a governance perspective. So you have that those layers. So for us, like the REITs here that were represented, I think that Raghav used to run, that I'm running currently, we report to a board of trustees on a quarterly basis, or as regularly as we actually need to. There are times you need to walk with that journey with the trustees very regularly, and it's just they're not takers of what to tell them. They actually sit back because a lot of the risk sits, actually most of the risk sits with them. So they have to ask those hard questions. But so that's the first layer. The second layer of governance for REITs is sits with the REIT managers board. Now the REIT manager has to have a board. So for us, we REIT managers. Fahari is a REIT manager. And we have a board that then the management will report into. That is the management that is expected to do the bulk of the work. Actually, that board is expected to do the bulk of the work, ask the questions first of the management, and deal with the arising risks. Of course, set the strategy in terms of the direction the company is taking, and then have that also then canvass through the trustee. So governance for REITs is, if you look at it, it's quite heavy. It's almost the regulator will require certain names. You require to see more of, actually even from a REIT manager's board, it's an independent. A lot of the board members will be dependent of the REIT itself, of the REIT managers themselves. The trustee largely is considered independent. Most of the trustees sitting up there, most of them are actually independent. You'll probably find they have no dealings even with the REIT. So from a governance perspective, you might consider that being quite heavy, but I think REITs globally, because of just the structure, they heavily regulated. So you have these regular meetings that, as for any other company, you've to report on operational matters, you've report on strategy matters, you've report on people matters. So you report on all this, and we almost have to check on anything. We can't actually take any action as REIT managers if that has not gone through the board as well as a trustee. We're not able to do anything if that has not gone through that. The manager, we can actually get an approval from the board the REIT manager's board, but not get it from the trustee. So I think those two levels really help in the ongoing governance of REITs, and that's why from really a governance issues, not had issues from the REITs that are in the market. Now, coming back to the other question that is asked on unit pricing vis-a-vis asset pricing. And I think if that question, if it came from Zorava, as you've pointed, it's probably looking at my REIT and the mispricing that he saw in the market vis-a-vis the net asset value. So you have asset pricing that is represented by NAV, the net asset value, vis-a-vis the unit pricing, then that it's a unit pricing you're seeing on the NSC, on the market, where there was a huge discount. Now, for us, that's definitely a misnomer, and we picked that out very quickly. I think when the REIT moved from Stanlip to ICA, that is one of the things that was picked, because REITs globally really don't need to deviate that much from NAV, either way, up or down. You have a very short band. If you look at REITs, you don't need to deviate that much. Actually, the unit pricing needs to reflect the asset pricing. The two prices almost need to converge at some point. And for us, we realized that was a problem. And even today, now it's not listed on the NSC, but it's a concern. But several things, and I'll start with the scale. I think you've heard Raghav talking about the scale. REITs need scale, definitely. And how you scale and where you get that scale is another conversation. But REITs need scale. For us, and I think it's something that we've put out in the market, we realized we need to be at around 8 billion at least to be able to be at a point where unit pricing will start reflecting asset pricing, especially for an I-REIT. Why? REITs, again, because they are regulated entities, we expect them to run two levels of costs. Traditionally, every property owner knows that to have the property level costs, you'll have to deal with those maintenance costs, you'll have to deal with no more going costs for cleaning, for all that. But then, because of the REIT structure, you have to deal with the secondary cost level, which is the fund level costs. Now, the beauty with fund level costs at scale, you realize they don't grow that much. They almost tail off. Currently, because of the scale, like for Fahari, you find that the fund level costs as an attribution of costs, it becomes quite significant. That is one of the things that we realized we needed to deal with, because currently with the team that I have, we can still actually, probably an additional 1 or 2 staff, run a 10 billion shilling REIT, a 15 billion shilling REIT without growing that much. And in so doing, you find even the service provider costs coming down from the REIT, trustee costs, the REIT manager's costs. Once you start collapsing that, ideally then, you should have that pricing of the unit reflecting the asset pricing itself. So for us, we've realized that's where we need to do, and that's where we need to grow. And that's why growth for us becomes very key. But also this takes you back to the conversation of the assets. What assets do we put into the REIT at the very outset? That question needs to be answered, because you need to get in at a good yield so that you don't have that disconnect, that major disconnect. If you get it at low yields, you definitely suffer that mispricing. That we can guarantee you from experience. Thank you.
Well answered. So questions? I think we've been speaking up here for about 35 minutes.
135. Okay, I'm going to allow 3 questions, one for each panelist. Yay, we've got one in the corner here. We're looking for short, sharp answers because stomachs have started grumbling. Please, go ahead.
Good morning. My name is Andrea. I work for Haas Consult. My question is to Raphael. You mentioned that you require much more robust than usual due diligence and partially technical due diligence, which lawyers cannot do for you, where you need to check hidden defects, energy efficiency, things like that. And then you mentioned that you require much more hands-on approach to facility management and maintenance. So do you have these functions in-house or you outsource? And if you outsource, is there a market for the services, and how do you ensure consistency? Thank you.
Thank you. Yeah, actually, from the REIT regulations, that facilities management component as well as the property management component is a function of the REIT manager. So the REIT manager is expected to provide that service. Now, whether you do it in-house or you outsource, it's a decision to make. Now, for us, we've outsourced through Knight Frank, from both the 2 perspectives, property management and facilities management. Definitely what we realize and what we've seen in the market, the facilities management component has been relatively weak in the past. And I think a few teams, even Knight Frank, realized that and they started beefing up that team. So we have a pretty hands-on team now on overseeing our facilities, as overseeing our buildings. They are almost on a weekly basis, they've probably be reporting on various items. But we will need it because, as Azmeena indicated, facilities management, even above the property management component itself, is what can sink you for in any property, in property, ongoing property operations. So there's still room, I think, in this country. We still need very robust facilities managers. I've seen a few have come up, but we actually need that. There's space and definitely room for more. And a lot of developers, KPD was here, I think Ken was here, he could speak to that. There's need and there's actually demand. Yeah.
I smell an opportunity for Haas Consult. Watch this space. All right, next question, please.
Hi, my name is Ravi from Carib Homes. My question is more about the offtake and addressing your issue of yield mismatch. So in, say, in affordable housing or even housing in general, you've got yields that might be at 6 or 7%. Then you've got risk-free yields, which is government bonds, maybe at 16, 17%. Then you guys are sitting at maybe what, I'm guessing at 12. So how are you going to buy stock when your stock is currently yielding well below what you require? Just curious.
Yeah, I wouldn't. But you got to do it. And I think, look, this was a challenge in capital raising that I faced, and I'm sure everyone else is currently facing as well. The government is your number one competitor. You're not competing with anyone else, frankly, if you're launching a REIT, but it's not just REITs competing with the government, it's everyone else competing with the government, right? So the government right now, by offering risk-free, and I do that on purpose, of the fake apostrophe, by offering that rate is crowding out capital from private sector investment. And I'm sure that's something that everyone who's a business leader is facing. Do I think that is a sustainable approach for the government to take? Unlikely. And I think there is going to be some rationalization that takes place over time, particularly the next couple of years. I think when you, as an issuer of a REIT, are out in the market, the way to approach any investor dialogue is not to say, hey, compare me to the government, because then you're frankly, they're not going to be investing in anything, because they should be comparing the government to everything else, like I said. But the proposition should be, compare me to other real estate alternative offerings, right? How do I compare to that? How do I compare to the real estate? If you're, for instance, speaking to pension funds, how do I compare to the real estate holdings that you have, right? Am I able to outperform against that? Am I providing you an alpha against that? If anyone here tries to compete with the government, you're on a losing streak, so don't do it.
I was optimistic. Thanks, Raghav. All right, one more question here.
Hello, my name is Diljot. I'm from CIC Asset Management. I have two questions which are related with sustainability and responsible investment. So what role do asset owners play within REITs governance structure, and how their priorities influence strategic decision making related to sustainability and responsible investment? And number two, how REITs collaborate with service providers to enhance ESG disclosures, reporting, or sustainability performance management? Thank you.
Azmeena?
That probably needs to go to the REITs managers, right? Because I'm not one. I can answer the sustainability point, but I mean...
You can all answer. I'll give you all a sentence.
So I mean, already, I've sort of touched on this, but yeah, sustainability plays a role in the entire property life cycle, right? And it's really critical during the operational phase, which is, going to be 50 to 70 years, as opposed to the development cycle, which is very short. And so optimizing the performance of your building, right? And a lot of this is related to sustainability, right? I mean, it's your consumption savings, your energy, water, how you do your waste management. All of that is the sustainability components of managing your building. And so to answer that question from an asset management perspective, obviously that it is very, very critical that you are making sure that you have best practices in every aspect of sustainability as a part of your asset management strategy. And again, systems, processes, data. A House Consult asked a question about facilities managers. One of the things that I didn't touch on that I do need to say is that the technical competence of your facilities managers is critical to making this work. They need to know their building inside out. They need to know that equipment and how it performs and what you need to do to fine tune it to the point where it's performing at its best. All of that is critical. So looking for the right technical team with that quality of experience in how to manage buildings, people who live and breathe buildings, is critically important. Again, the data that you collect as you're doing your asset management, a lot of it is what will feed into your ESG reporting during your operational phase of your facilities, right? So that again makes it a very, very important component to integrate into your facilities management processes is the data collection aspect. I cannot stress on that enough. Thank you.
Anything to add, boys?
Yeah, just a quick one. We actually required to, even from an NSC perspective as well as CMA perspective, today, if you're publishing those annual reports to indicate how you're dealing with ESG matters internally, sustainability matters. So if you look at our annual report, which will be out in another month or 2 weeks or so, you actually see that we'll have that section on sustainability. It's a key requirement of reporting. And for us, as Fahari, we walk the journey with a consultant who is proactive, looking at our properties, looking at our processes, looking at what we can improve, of course, looking forward even to how do the acquisitions of new properties, how do we embed this component of sustainability? And even in group-wide, we have someone who is also guiding as an employee internally, guiding us on this sustainability journey, because we require to make not just top-level disclosures, but very detailed disclosures on how we're reacting in that space, or how we meeting the challenges within that sustainability space.
Thank you very much. Please, a round of applause for our panelists. Thank you. Please take your seats. All right, good news is we've got one short presentation, 10 minutes presentation before you get a quick cheeky coffee bathroom break. So please stay with